Welcome to This Week in Sonar. I'm Craig Fuller here with Zach Strickland. Zach, we're kicking off March Madness. Lots of exciting things going on. My Baylor Bears have not taken to the court, so I don't know how they're going to do in this tournament, but I certainly am optimistic about them winning. Who do you have?
I've got the Zags, man. I mean, I got your Bears going deep all the way to the finals, but I got the Zags. They're going to score. They're going to put up a lot of points, man. It'll be a good game, I think.
You know, Baylor only lost when the team was out. Part of the team was out for COVID. So, they remain mostly undefeated. I've lost 2 games this year so far. Can't lose in the tournament. Hopefully they'll do well. But we're not here to talk about basketball. It is an exciting time. It feels like the world is returning to some normalcy. And Sonar is returning to putting out product on a weekly basis. But let's talk a little bit about what was released last week for our newest iteration of lane acuity. What exactly did we see last week, Zach?
Yeah, so we released Lane Acuity, part of the Sonar supply chain intelligence platform, that we basically had a shipper focus when we started building it out. And a lot of what it is rate benchmarking, number one, so you can compare your rates to peer and market levels. And then you have this volatility measurement that allows you to see, well, how stable is that market or that lane in comparison to the rest of the market? So how easily can I rely on my carrier compliance in those lanes?
The volatility indexes, I think, are the most interesting of like comparing rates against your competitors. That's interesting and important, and it's an important function. But to me, the volatility indexes by lane are really important for shippers to know what lanes pricing is likely to break down. And this is not just about seasonality, which is certainly a factor, but it's also about all of the other data points that whether capacity is thinly represented in the market, whether there are demand inconsistent cycles, but a lot of things can drive those scores up and down.
Yeah, I think one of the things that's hardest for people that don't necessarily exist in transportation to understand is how stable is an environment? How stable is the market? I mean, there's nothing out there that's really allows you to easily measure volatility in certain lanes. So you just kind of, a lot of the mentality is go find the lowest cost provider and just kind of ride that wave until it runs out. But a lot of people are finding out over the last year that that may not be the optimal value point because if you go with a low cost provider and the market or the lane destabilizes on you, then it forces you out into second, third tier route guide, provider, and even into the spot market where you're paying 30 to 40% more. It may not make a lot of financial sense to always rely on that low cost situation.
Yeah, one of the things that I think is sort of the nasty secret or reality is that sometimes when carrier, if the market's soft, or if a carrier knows they're going to have times of the year where they're going to have excess capacity, is they will lock in a low rate with the intention of honoring that rate when conditions are favorable to honor it or not tight. But then they know that the rate's going to go up when we hit produce season or when beverages hit or they have another project. And so just getting the lowest cost provider on a lane doesn't tell you much. It's interesting. I was having a conversation with a shipper earlier this week, and they were talking about using this tool to actually dive into, I'm going to lock in my general routing guide to 4 vendors. I'm going to have 4 carriers that are on my routing guide, except for those really, really volatile lanes. I'm going to increase to 8. I'm actually going to double the amount of carriers that are on the routing guide so that I have more insurance or security to know that I don't have to hit the spot market with freight. It helps me protect the amount of money and the vendors that I'm using.
Exactly. So, I mean, that's exactly the point is how do you de-risk your transportation spend? I mean, the worst thing that could happen to a shipper is they blow their budget. And nothing will blow your budget faster than having to shift too much of your, spend to the spot market, especially in a market like this.
Yeah, and it's also not just increasing routing guide, but it's also putting a little bit of insurance on those lanes, maybe padding the number with 10 to 20 cents of additional. When you do your budgeting, you obviously don't want to pay the carrier more than the carrier is asking for, but it's protecting it. Now, I have seen situations where shippers will pay more if they know the lane is more volatile. Uh, they will end up offering a carrier more money to take those lanes if they know they're going to show up. A more dependable, consistent carrier may get a premium on those volatile lanes, whereas the lanes that aren't volatile, they're going to expect you to be as competitive as you possibly can.
Exactly. And one of the use cases we're exploring too, and this one's probably one of the more easily understood ones, is maybe, a lot of the shippers that I've talked to over the past several years, they talk about how they're not seeing the same situation as a majority of the market. And what I tend to ask them is, well, do you think that you might be overpaying in an area? So, if you are getting that 99% compliance rate when everybody else is sitting at a 75%, that means that you might be paying a premium to get that compliance. So, doing the calculation and figuring out, okay, what if I were to drop down to just target a 95% compliance or be okay with a 5% spot market exposure? What does that do to my overall budget? And it may lower my costs.
Yeah, it is also may be that when you think about having to hit the spot market, you tend to hit them in the same consistent lanes. Like you said, either I'm paying a premium, maybe I think that I'm paying a premium, but the reality is the lane just isn't very volatile, and you can discover that with this new tool. The other thing is, maybe this gives me the chance to understand where I'm going to have my risks and where I need to manage to those risks by increasing my budget or increasing the depth of my routing guide. I think that's really the tools. I often think about freight very similar to managing a portfolio of investments. Is having some fixed income, some bonds in your portfolio, some dividend stocks that are low risk are important because they provide you with consistent financial security. But if you only do that, the returns are going to be negligible compared to if you take some of the high growth equities. You also want some, at least I do, I want some more volatility in my portfolio because I want more growth. And I think if I am a shipper, there is some advantages of having some optionality. It may cost me a little bit on the downside, but it gives me much more upside. Maybe it's more flexible options to be able to hit more capacity providers that may have more capacity available when I need it to surge. All of it's very similar to managing a portfolio.
Yeah, I think too that this gives you that ability to see where you have those opportunities on a granular level. I mean, you may be very comfortable in the top 5 lanes that you have. You just all your volume is in your top 5 lanes, and then you have a huge exposure over the course of the rest of your lanes, which may be 100, 200 lanes, but you don't really understand them that fully. And this tool allows you to kind of identify where you have some of those holes and exposure that you can actually squeeze a few extra dollars out of.
Yeah, it's an exciting time. I think getting into being able to splice the routing guide up, being able to see competitive cohorts, being able to see how these things trend over seasons is really, really important. Again, all of this data is painted every single day. It's refreshed every day. This particular data set is pulling in contract rate data. So you're able to see contract rate data, $20 billion of annual data, $80 billion over the course of 4 years, combined with all that tender, loving care in your tender data. It's a beautiful thing.
Right on. Well said.
Well, Zach, till next week, sick 'em Bears. We'll have a great one.